because if the fair value gap is your PD array, if that's what you're using to trade buying and selling, you're going to meet a time where you expect these things to perform a specific manner or function, bullishness or bearishness. But when they fail, that gives you insight. That's what a inversion fair value gap is. That's what it is. It's inversion. You expected it to behave a specific way, but it goes through it. Well, here I'm anticipating price going through this very fair value gap here for the express purposes that it will hopefully provide a shorting opportunity that would accelerate further downside. And this becomes an inversion fair value gap if we trade down but not below this low before returning back to it, because that sell side's still there. And it would return back to this fair value gap because it would treat this as an inversion fair value gap. There's only buy side here on this candle passing through. We didn't get to it here. We went just shallow into it here. But from this candle's low to that candle's high, there's only buy side. It was delivered only here on buy side. So what is it missing? Sell side. So if it drops down, it offers that sell side to this candle's high. So it reprices to that range low, which is this candle's high. So that fair value gap has been repriced to offer the buy side that's been given here and then sell side. So if it moves away from it, comes back up, what is it going to act as? A balanced price range, which is the reason why I'm telling you that I would like to see it only trade to halfway. It can trade up to the highest point, but if it tells me, no, I'm not interested in going all the way up to the top of it after moving below it, if it hits the low and only stops at midpoint or just below it and then starts to move lower, that's exactly what I want, because it's signifying that the balanced price range is not permitting price to come all the way back up to the high of it. It need not do that. Why? Because we've already traded down to it a little bit in here. So we've already had sell side offered to that degree on that candle's low. If See, this is the part you don't want to hear. You want me to get to the nitty gritty and make it easy here to buy, sell, and expect it. But if you want to learn how to make money and consistently know what you're looking for, why am I using this candle? Why am I not doing this? And why am I expecting this range to stay unfilled? And why should I expect this one to be filled? Well, I'm teaching it to you. But it can't be done in a 5-minute video. If this candle didn't trade down into the upper portion of this fair value gap, if it didn't do that right there, then the one pass through it, where I expect the fair value gap to fail here, not offer support, then I would treat the inversion fair value gap as it can go all the way to the high. Why? Because it wouldn't have had this drop down in the upper portion of this range. See that? But because it did that, it's already offered a measure of sell side. So between that candle's low, which I'll highlight here, what I'm saying is essentially I don't want to see it trade above that blue line. If it trades down, worst case scenario, it can create a mohawk, which is a little tiny little deviation above or below a level that would be the level I'm looking for to be respected. But because markets are factoring a spread, and we all know Forex has a spread. I don't care what they tell you, what they offer you. Oh, I have spreads that are this and whatever. If the broker wants to expand it on you, they're going to expand it on you, and then it is what it is. Unless you're using a limit order, if you're using a market order, chances are that spread isn't going to be what you actually get. And how often are you really checking to see what you paid in spread? You're not. You're just hoping to get in there because your fear of missing out is so high. That difference between this candle's low and the high of the fair value gap, which is this limit here. So I'm going to highlight both levels. I don't want to see price, if it trades down below it, I don't want to see it trade back up in between these two levels once we get below this shaded area. Because the effects of this candle trading down to the upper portion of this fair value gap, it's already offered on the basis of this move here. That candle right there, that day, has already delivered most of the upper portion of what would be this fair value gap. So because it has done that, I don't want to see if we trade below it and then it comes back up and touches the low or halfway point. I want it to be sensitive there and not trade any higher. But it can create a small little mohawk just above that line there, but not touch the upper portion. If it does that, that tells me it's exceedingly weak, and then therefore I would expect dollar to accelerate higher. And then any shorts that I see in NASDAQ should be high probability. And then this should sell off pretty aggressive, reaching down for the sell side below over in here. But if this candle hadn't done this very thing here, that means that the only thing that this fair value gap has seen, again, this portion right here, imagine that's not there. Say this candle had a low up here. Okay, that means that this range only had buy side offered to this point here. So what's it missing? It's inefficient in sell side because it's buy side imbalance. That means its direction was a closing candle higher. The difference between the candle before it and the candle after it is that there's a little gap in between where the market has to eventually reprice lower. We're not down there yet. So when you look at a fair value gap, you have to see how was it treated, how was it utilized. It wasn't even touched here. I said that wrong. it wasn't willing to trade down the consequent encouragement here. It didn't come to the very low of that candle here. It didn't respect that. It traded just inside the upper portion or upper half of that gap that's created by this candle's high and that candle's low. So because it's done that, I don't want to see it once it trades back down below it. I don't want to see it come back up and touch the top. But if this wasn't the case here, then I would expect and I would try to take a short higher up above the consequent encroachment of the fair value gap. And if I can get a mohawk right here on the high of it, or if it just pokes itself above it, many times you've seen me do, I'll add a partial and pyramid in that very thing right there. And you've seen people ask, like, why were you adding to it? It was outside the fair value gap. Because the mohawk is expected. It's permissible. We allow for it. I'm not scared of it. I know it's likely to occur. If I can get fortunate enough, notice I didn't say lucky, if I was fortunate enough to get the fill on that mohawk that just punches just above that, that's superior entry. That's part of the game I play when I'm trying to get fills. Like I want to try to do that sometimes. I'm not successful all the time because the market's gyrating all around, and hopefully I've made a major dent in your understanding about inversion fair value gaps here. I tuck it in to these these long-winded videos because these are the details. These are the details that, let me just make sure I didn't break my phone here. I told myself when I laid it on the armchair next to me, I'm probably going to drop it. And that's good. Just last until November 12th because I'm turning this son bitch off. So now you have insights. When do I expect the fair value gap to fill? Why would I expect it to fail? Why would I like to see things remain open? I covered all that right here. Okay. So in my book, when I talk about inversion fair value gaps, I'm going to cite this very video where I walk you through the explanation with an example, because everything I just said in text, you might read it and say, I don't understand what he's saying. But now you've seen me outline it. You've seen me refer to it here. In every example where I've ever shown the trade where I've used it and you watch me call an inversion fair value gap before the market itself respected it as such, now you understand the dynamic of what I trusted at the time. Because it's not make-believe and it's not hindsight. It's logic that's being referred to on an ongoing basis that will tend to repeat more times than it will fail, and then in and of itself, that is an edge. That's a model. That's something you can put statistics and probabilities behind. And if you can determine when the market's predisposed to go higher or lower, that by definition gives you high probability. And if you can't do your trades with that mindset behind each and every one of them, you're gambling. You have no idea what you're doing. You're just hoping and praying. And when it's right, you'll call it skill. When it's wrong, you'll blame me. You'll blame the methodology. You'll blame the broker. You'll blame the market. You'll blame everything else but yourself. So this discussion is just reverting back to you as the responsible party. When you do it wrong, you did it wrong. Everything else is exactly what it is. It's separate from you. These gaps don't make you buy them. They don't make you short them. You decide that you make that decision. So I'll move on because I could go on a lecture about that.